where we discuss about lot of aspects that the business owners need on day-to-day basis with regards to finance, tax, accounting, and business side. So let today we have a very distinguished guest on our show, uh, Tejas Sanghvi. He has been a banker throughout the journey for more than 18 years now. He has been part of credit teams of Yes Bank and Kotak Mahindra Bank for a long stint and has been very highly experienced to look at corporate funding and MSME funding and funding for different products and types of products over the period of his career. So welcome Tejas on the show. Uh, our focus, as we know, is to help entrepreneurs understand basic concepts of finance in a very simple language without any high class terminology or any complex things which an entrepreneur wouldn't understand. So we will make it very easy and simple for everyone to understand. The idea of today's session to get Tejas on this series of finance and organized finance is India is growing at a very fast pace. As we all know, the elections are just over, and there is a bit of problem, but lot of positivity that we will hit $5 trillion economy very soon. So all the companies, all the entrepreneurs, business owners who are wanting to zoom their businesses would need finance or capital as one of the key aspects of growth and progress at a faster pace, wherein they can capture larger opportunities and at the same time mitigate the risk of own finance and at the same time getting into banking channel and accessing the organized funding as and when required. So with this preface, we will get on to the questions for Tejas on today's call. Uh, Tejas, the first question is, when does the need of funding arise for companies who are in a growth stage?
So thanks, Mitesh. Thanks for the nice introduction. And yeah, we would like to make this, I would say, platform good for entrepreneurs as well as the business owners, where we can try to help them on the finance aspect of it. So thanks for the introduction. Yeah, and coming to your first question, so when does the need for funding arise? So obviously, as you are all aware, the business obviously started with their own capital. Obviously, the initial phases where you actually need to grow and start a business is the own capital that is employed by the promoter himself. Now, depending upon the business model, so even if you ask me in today's market, there would be very few businesses who would be not needing funds because everything is coming in advance. So even for a retail business, if you ask me today, which is like we feel that the business is of cash, we sometimes feel why do they need finance or something of that sort. So obviously they have their own expenses to cater to, etc., etc. So coming to your question, when does a company need finance? Obviously, there are various stages of the growth of a business. Initial funding obviously is done by the promoter. Now, as and when people go ahead, depending upon, again, repeating myself on the business model, there would be a lot of places where there would be credit that needs to be given to your customers, where obviously you would not get that same amount of the credit from your suppliers. So just to bridge that working capital gap is the time when actually the need for funding arises. Now, getting into the depth of that, what is the sort of funding that would be required and at what stages? So now coming to the first channel, so there are various ways of funding: the promoters capital, the debt fund, the venture debt capital, private equity. We know a lot of IPO funding, etc., etc. But there are stages to it when what sort of funding is, I would say, pretty optimist and optimal for the client. So now the first is when I say optimal, that is coming to the cost of funds. So when I say the first requirement is obviously once the own equity has been exhausted, there is a decent growth that the company has achieved by its own capital. That is when the need for actual funding will arise from the additional sources. Now, for me, the prime, when should you start borrowing? That is the time when actually you are able to pay the interest. It looks like a very simple statement, but honestly, the time when you are capable enough to make sure that the interest payments are going to be serviced by your cash flows is the first start of borrowing money. Now, going further to the stages on how much money to be borrowed, what is the way of borrowing, what is the product of borrowing, there are various ways to it. So that obviously can be discussed depending upon the business model, the industry, etc. So simple way to start a funding for any normal business is nothing but a cash credit, where there is something which is available in the form of working capital, which is a fund-based limit. That is a normal way of starting a normal banking fund that you can actually think of.
Great. So this brings me to the second important question as to the thumb rule of deciding what is the amount that I, as an entrepreneur, need today for growth of my business or encashment of the opportunities that are coming in front of me. How do I calculate that?
Uh, so honestly, there is no as such thumb rule, but I would put a way of calculating that sort of a limit on what could be the fund-based requirement could be, or what could be the requirement of capital would be. Generally, it purely depends on your working capital cycle. Just to again not name a few jargons, but what is the sort of inventory that you need to keep? What is the creditor cycle that you have? What is the debtor cycle that you have? So once you calculate that working capital cycle, obviously when you go to funding, so I'm talking about say the bank channel, the bank can fund you approximately 75% of the working capital cycle because the banks expect 25% to come from the promoter margin as well. So this is the optimal combination of what could be the funding that could be available. Obviously, if it is at the start of the journey, the bankers or the guys who are investing money would require some sort of security, which comes basically in the form of collateral. So just I could start here with the stage when there are a lot of funding. We have heard about the jargons called as CGT MSC funding. So this is sort of a funding which is done by entrepreneurs at the start of the stage where they do not have any collateral to offer. So, but let me put it very clearly, the banks also get into CGTMSE funding when they see a vintage of the business, that what is the margins of the business, is the promoter, I would say credentials or credit is very strong enough if they can lend to the company without any collateral. So coming to that, on that front, when you said what is the optimal limit, there is a way that the bank calculates. From the client's perspective, I think obviously he would put majority of the capital from his own side. He would have exhausted all his sources and all those things, and there could be a limitation of collateral that could be available, that could be offered for the funding that could be required. So based on that, based on a ratio, the prime. So just to add a number here, there is a equity debt equity ratio of around 2, which is acceptable on a higher side for a banker. So just to throw you an example, if you have invested 1 crore from the capital perspective, the maximum debt that can be raised from a bank is 2 crores. Obviously there are exceptions to it, but that depends upon the growth potential, the vintage of the promoter, and various other factors.
Great. So getting into uh, a paraphrasing of what Tejas is talking is the companies when they reach at a certain stage and have a lot of opportunities in front of them, but their own capital is falling short to meet those opportunities. So for the growth, for the additional growth, for the leap, they need to use working capital funding from the banks. That is the starting point of borrowing that starts. So borrowing in the form of working capital actually calls for doing a lot of calculations with regards to working capital need and the working capital cycle and other things. But at the same time, to put it very simply, if you have invested 1 crore into your business, then you can raise at the most 2 crores from a banker to start with. And that will give you a leverage of 2x on the top of your capital to fast track the process of growth into the business. But at the same time, the banker looks at other aspects like the promoter's capabilities, his education, his skill set, his background, his credit rating, and so on. And also on the other side, the banker also looks at the prospectives of the business, and the promoter has to actually prove that there is a potential which is untapped, and with the help of bank funding, he will be able to tap that potential. Lastly, what Tejas says is very, very relevant. He says that you should be able to find ways to fund the interest servicing to the debt that is going to be taken. And you should be very, very clear on how we will fund these interest payments and the payments of debt that is going to come to you. So it is very relevant and useful information for the entrepreneurs to pick up and understand. Let's go to the next point,
So with this, sorry,
where
I'll just add one more point
yeah,
here. I'll just
yeah.
add one more point here since you were actually concluding the entire thing. So there is also something called as a greenfield project. So where there is something on a manufacturing side. So as we spoke about the working capital from a normal business perspective, from a trader's perspective. So there is a possibility of funding to be raised for a greenfield project for setting up a new plant, say land and building, plant and machinery, plus the entire expenses to be done. Obviously, that comes up with their own entire projections, the feasibility report, the TEV report, which is slightly technical on how is the feasibility going to be there for the project. Also, coming to the how can it be supported by a security? So yes, it is supported by some another collateral security which is not directly linked to the project. But there are sort of funding possibilities available for a new project, which is a greenfield project. But depending upon the again the credentials of the promoter's background. Just to share an example, a promoter of 20 years of experience in a particular sector has started up a new project because of his experience, because of his knowledge, because of his skill set. And when he sets up a greenfield project, obviously because of his credentials and the market connect and all those things, there is a possibility of the business going to the next level in a few couple of years. So there is a possibility of even a greenfield project for a new sort of funding for a new promoter in that business. So that is, I wanted to just add that. So there is that sort of a possibility also possible for a new project or a new business.
So to paraphrase this again, there is a possibility of working capital. That is the first model of funding that most of us need. The second model of funding, which are very capital intensive in nature, the companies with more capital requirements may need the funding on another side. That is on the side of machinery or upgradation of plant or upgradation of the building or setup of the company for making more products that are required to be available in the market. So even that is possible. And
Yes.
more importantly, Tejas also points out that there are possibilities of looking at initial stage funding like CGT, MSC, and others where the collateral is being given by the government, or there is a potential that if the promoter's vintage is really very good, then we can manage helping the companies through proper banking channels to get funds without much of collateral requirements. So that is very interesting and very useful information. Now let's get into the process stages. So we will discuss about what is the typical process that an entrepreneur needs to follow if he wants to get into a banking channel, uh, be it working capital finance or be it finance for setting up or upgradation of plant and machinery. Just give us the steps.
Uh, so Mitesh, again, coming to the steps, what they need to do to raise the finance for that matter, just to understand. So there are some basic requirements that a banker or any investor, I would put here an investor as well, who would like to study if he wants to invest in a company or he wants to lend to the company. So the basic process is nothing but obviously the bankers today obviously need a vintage of at least 3 years. So basically the last 3 years of audited financials, the company profile, basically what is the company into, what are the products, what is the business model, what is the working capital cycle, what are the USPs of the company, what are the list of products, suppliers, customers, etc. This is the basic company profile that the company needs to prepare and explain their business model. The financials take care of the last 3 years of the P&L and balance sheet on how has been the balance sheet on the leverage perspective, how has been the profitability, etc. Once these documents are there, obviously then comes, once the assessment is done basically on the business, promoter as well as the financials, the next step comes on is what is the optimal way of. So as I said, again, coming to the thing, anybody would want to not provide the collateral at the start, but obviously the financials as well as the balance sheet should justify that. So first option comes is as a C. So if again coming to the CGTMSE thing, the CGTMSE rules also states that the bank cannot borrow from any other bank by giving the collateral. So it is not that I have taken a CGTMSE funding from one of the bankers and ready to provide the collateral to some other banker. So idea here is nothing but this is a support by the government to help an entrepreneur and who is actually having a very good business model, good business potential, but is not having the adequate collateral security to take the funding forward. So that's a clarity which I wanted to give. So yeah, coming to that, that is the starting stage when a new entrepreneur starts to get the funding, which is a smaller funding, a sort of a CGTMSE funding that he gets. Then coming to the next level of funding, wherein depending upon again his credit profile, etc., there is a percentage of collateral that is determined by a banker. So he gets to then negotiate with the banker on what is the best availability of funds. And that is the process that I would say, yes, he needs to have the financials in place, the business model in place, the basic understanding of what is the collateral level that would be required, and then going to the next step about negotiation on the commercials. And these are the various steps where a guy who is looking for funding needs to understand as well as negotiate with the guy who is going to lend the promoter.
Super. Let's get into the last question
Yeah.
of the basics. If I've already say done all these processes which you have suggested and got the first trench of organized finance for my company in the form of working capital or in the form of term loan, which is for upgradation of my plant and machinery and equipment or building and so on, and I've started my business and the turnover is rolling. What are the routine compliances required to be done with the banker in this scenario, and how I can take care of my sanctioned limits in a systematic manner so my credibility continues to be stable and growing over a period of time, and the banker also gets more confidence in me to give me more funds at the time when I have opportunities in hand.
I think that's a wonderful question. Generally, a guy who takes the money does not ask this question very often. So nice you pointed this out and all those things. And this is the most important aspect of getting a funding from a banker. Because as and when you grow, the banker also is like a partner and he needs to grow with you. But he gets comfort from a various factors. So as rightly mentioned by you, there are a lot of compliance conditions which a banker, when he gives a sanction, generally puts it and monitors it on a regular basis. So from a client's perspective, from a customer's perspective, obviously you need to ensure that you are adhering to all those compliances. So just a few examples. What does the banker, I would say, monitor? So obviously you would have, when you have taken for a term loan, for example, for a 5-year tenor, you will obviously give the projections of 5 year on how the company is projecting these numbers based on a few assumptions, which has been obviously validated by the company as well as the stakeholders. So what you need to do is nothing but obviously you need to track that. You need to track that on how is the projection that was given. Are we on track? Are we behind track? How are we on that? So there are various ways on it. When I say there would be stages where you will obviously go slightly behind the projections and all those things, but that would be related to the market conditions, to the industry conditions, which is not applicable to your company, but to the across the entire industry. So yes, that is, if that is getting tracked, when you answer to the banker also obviously understands the industry because they have also the exposures across the industry. But that is when, if you are very compliant, if you give proper reasoning, if you give proper logic and all those things, banks reconsiders the same. If you are on track, if you are better off and all those things, obviously you can go to the banker, ask for better commercials, ask for higher limits of enhanced limits based on the growth that you had projected and what you have achieved. just to name a few parameters, as you rightly asked, what could be the things that you need to monitor? So there are simple ratios that are there either on the P&L side or on the balance sheet side. People monitor the profitability, the cash profit, whatever was projected as per the projections that were given. On the leverage side, obviously there are ratios on the equity side. What is the debt equity ratio? What is the TOL upon TNW ratio? Slightly jargon, but when I say that TOL upon TNW, that is the idea where what is the net worth that the promoter has also built in during the course of business. So there are certain parameters which you need to understand. And if there is need of funds, so the banker has committed and given you decent amount of funds at your level. But as and when you grow, there is a lot of expectation that if you were looking for additional funds from the banker, there is a similar amount of equity that has been expected by you from the banker. So those are various terms and conditions which has to be monitored by the team if there is a decent team, or by the promoter at the starting stage, so that the banker gets more and more comfort as and more he spends time with the company. And that is where the majority of chances come of the enhancement of limits. It's not always that your enhancement of limits comes only from additional collateral. These factors like ensuring that whatever has been sanctioned, whatever are the compliance conditions, if they are followed properly, there is a highly likelihood from the banker coming into you and saying and asking for the enhancement of limits as well.
Great. I think this sums up very nicely the basics of finance for small and medium-sized entrepreneurs who are growth-oriented, enthusiastic, and have a lot of opportunities in hand, are able to see the future and feel the crunch of funding, can move to organized model of funding, that is bank funding, and systematically grow their businesses over a period of time and take a leap into the ambition or the future of the business with the help of additional leverage that they can access with the help of banking. Thank you, Tejas, for taking out time on this show and helping the fellow entrepreneurs and the business owners with regards to the basics of finance, organized finance, so to say, for all of us. We will continue this series over a period of time. Please feel free to share this video with your fellow entrepreneurs who are equally enthusiastic and wanting to grow at a faster pace and leverage organized finance for growth of their businesses. We will continue to have Tejas on the show over a period of time. And of course, you can ask your questions in the comment box with regards to any kind of issues on finance, and we will try to get Tejas to answer your questions and help you sort your issues and take you to the next stage with regards to your finance questions. With this, we conclude today's show, and we continue to bring more perspectives for organized finance from various industry standpoint and various different business model standpoint, like export, like specific industries like pharmaceutical or textile or construction or building real estate and so on over a period of time with Tejas. Please keep us posted with your comments and thoughts and ideas and questions, and encourage us for doing these shows more and more frequently. Thank you. Thank you very much.
So
Bye.
thanks Mitesh for this wonderful platform. Obviously, it was a real pleasure and would love to be on your platform discussing a few finance issues. Thank you.
Thank you, everyone. Bye.